Hey guys, Steve Ferguson here. Hope you guys are having a great day so far. Today we're going to talk about how to calculate debt to income ratios for several different mortgage loan programs, including VA, conventional, and FHA loans. So it's important to understand this. This is going to give you some clarity on how much home you can afford when you're applying for a mortgage loan. And I want to make sure that you guys can see the actual program that we use as loan officers to make sure that you have the necessary income to qualify for the home that you're looking for. So before I forget, make sure you click subscribe. Check out all my videos. There's a lot of information below that I would love for you guys to check on as well. There are lots of different videos that I put together on different loan programs and things that are going to be interesting to you. And so please make sure that you take the time and look at those other videos as well. All right, so let's get started. I'm going to share a little bit of my screen with you guys so that way you can see what it looks like. I'm going to minimize myself so you can see what I've got on my screen. So what I'm using right now is a program called Encompass. Encompass is the application system that we use when we do a loan application for a borrower. So as an example, I'm going to plug in some basic numbers here. They're going to give us kind of a framework to start on. So let's just assume right now that we want to do a home in the amount of $300,000 purchase price. So we're going to plug in $300,000 here. On a VA loan, as an example, we don't have any down payments. So there wouldn't be any down payment in this block. And so let's just assume an interest rate at this point in time, for argument's sake, of 3.5%. That doesn't mean this will be your interest rate. This is just a placeholder rate that I'm putting in here so that you can see how debt to income ratios are calculated. So we're going to put 3.5% in all the different boxes here, and we're going to assume that it's a 30-year fixed mortgage. So what this does is it gives me a principal and interest payment for the $300,000 purchase. Straightforward loan, no money down, VA loan. Now, if we want to get the actual payment, we need to include principal and interest, which we have, and taxes and insurance, because those are going to be required on every property that you buy. You've got to pay taxes. Property taxes is what that means. And so there's different taxing authorities that come in and levy a tax on the property that you're buying or that you own. And so you have to pay those every single year. We include that in the mortgage payment on a VA loan because it's required. So let's put in taxes right here. So we're going to give a tax rate, which is called a tax factor. And we're going to assume it's 2.25% of the total loan amount. Okay, so that's going to make the taxes on this property approximately $562.50 per month. Now you've got to have homeowners insurance as well. So homeowners insurance is insurance that applies to your property in case of anything that happens on the property itself, including fire, vandalism, somebody gets injured, etc. That's something you would need to talk to your insurance agent about to figure out more details on it, but we've got to include that in your mortgage payment so you have it there as well. So we always assume a factor of 0.5%. That gets us relatively close on the insurance side, so I'm going to estimate homeowners insurance at $125 a month. So now we have a pretty complete estimated mortgage payment that includes principal and interest, homeowners insurance, and taxes. And that gives you a total estimated payment of $2,034.63 per month. So we have to have this information in order to derive what our debt to income ratios may or may not be. So there's a couple of steps that we take in order to figure out your debt to income ratios. So let's talk about those for just a second. The first thing we're going to do is we're going to plug in income. And I'm going to show you where we do that on your screen here in just a second so you can see how it works. And then we pull a credit report and we populate what are called your liabilities. So on your credit, you have certain things that you pay every single month. It could be a car note, it could be student loans, it could be credit cards. Whatever is reported on your credit report, those are called liabilities. So what we do is we take your income and we compare that to your liabilities and your new mortgage payment. And that equals, then we figure out your debt to income ratio based on those details. So let's go ahead and put a little bit of information in so that way you guys have it. So we're going to go ahead and plug in employment information. So on this one, we're just going to assume basic employment details, and I'm going to plug in just an income at this point in time. So what I'm going to do is I'm going to assume a yearly income of, let's just assume $75,000. Okay, so that's $6,250 a month. So now we have income in the file. I'm going to use the same income across everything that we do. All right. Now, if you look at the top, It's giving me a debt to income ratio of 32.554%. The only thing I have right now is just the mortgage in here compared to the income we just put in. So that means the mortgage payment is 32.554% of your gross income. That means it's a 32% debt to income ratio. Now there's two debt to income ratios on every mortgage loan. There's your front end debt to income ratio and your back end debt to income ratio. And this is important. I want to make sure that you understand this. Your front end debt to income ratio is just your mortgage payment by itself. So our front end ratio is a 32.554%. Your back end ratio includes your new mortgage payment plus any debt that you have on your credit report. So for example, if we had a $500 car payment, if we had $150 in credit card payments, that gets added to your mortgage payment to come up with a back end debt to income ratio. So that's like the back end is your total debt to income ratio. So let me explain why there's two different debt to income ratios. Fannie Mae doesn't want to have a situation where you're house poor. So if you had a front end and a back end debt to income ratio that were the same, let's just assume you were debt free and they were both 50%. That means 50% of your gross income is your mortgage payment. Fannie Mae, Freddie Mac, they understand that that creates risk on the loan because there's other things that you may be paying for, such as utilities or insurance on the house or whatever it happens to be that may not be included in your mortgage payment. And they know it can be a strain on a family member or a family to live in that home if they're house poor. And house poor just means that you pay too much money for your home in comparative to what Fannie Mae thinks is reasonable. And so we want to make sure that your front end ratio and your back end ratio are two different numbers. We do loans all the time where they're not, that they're the same number, but you just can't move them as high to qualify. And that's because, again, it's about risk. Fannie Mae is all about reducing the amount of risk to make sure that you have a good chance of paying your mortgage on time and for the foreseeable future. Just like if you were loaning somebody money and they asked to borrow $1,000 from you, but they didn't make, maybe $100 a month, and they had a payment that was $50 a month. Well, half their income that they would be making would be going to pay you back. And if they've got childcare expenses or they want to go grocery shopping or they want to go out to eat, they don't have the money to do that. So they're more likely to default paying you back for the loan that you just gave them. So that's kind of what that means in a banking, transparency, if that makes sense. So these are things that you would talk to your loan officer about, and they can educate you on these things. And every program's a little different for what is allowed on debt to income ratios. So please keep that in mind. But it's important to understand that there are two debt to income ratios on mortgage loans. So let's keep going. So let's go to the credit and liability section. Now, what I'm going to do is I'm going to add a couple of liabilities so you can see the difference in the debt to income ratio. So number one, we're going to add, let's just assume it's a car payment, right? So car payment, you owe $15,000 on your car and your payment's $350 a month. And then we're going to add one more debt. Let's just call it a credit card. Boy, I can't spell today. Credit card. And let's just assume you owe, $2,000 on your credit card and your payment is $50 a month. Okay. So now we have a couple of extra debts in there that will go in and help figure out your total debt to income ratios, right? So it increased our total debt to income ratio to 38.954%. So it's changing our debt to income ratio when we add additional things in. I hope that makes sense. So we're looking at just some different solutions here in order to make sure that, we're choosing a program that best fits what you're looking for. So let's go in here and choose a loan program just so that this calculates correctly. We're going to choose a VA mortgage loan. And the reason we do it this way is it automatically populates information into the system that allows us to determine that all the numbers are correctly done from the very beginning. So this is a purchase VA mortgage, 100% financing, and we're going to use this as a primary residence because that's what VA allows. And then what we're going to do is plug in some basic information in here. We don't have any idea about the house itself, but we're going to estimate the value. Let's just say $350,000. I'm missing a zero there, not $35,000. And we're going to do this one. Let me go fix this one more time. Okay, So we're going to estimate the value at $350,000. Now, if you look at the top, the front end and the back end debt to income ratio show. So we've got a 32.554% front end ratio and a 38.954 back end ratio. Because remember, the front end ratio is just the mortgage loan by itself. The back end ratio is the mortgage and the car payment and that credit card payment that we put in. Okay. So the cool thing about VA loans is there's not technically a restriction on how high your debt to income ratio can go. VA uses what's called residual income in order to calculate how likely you are to make your mortgage payment. So if you have excellent credit and you've managed your credit well, you've managed your income well, and you're wanting to buy a more expensive house than you might be able to qualify for in other programs, VA is going to give you the flexibility to do that. The beautiful thing about that is your back end debt to income ratio, it can be above 50% on a VA loan if you qualify to go that high. There's not a restriction on it. So that's great news if you're a veteran. What happens if you're not a veteran? Right? What happens if we just needed to go an FHA loan or a conventional loan? Well, there's different debt to income ratios allowed on those programs as well. So for example, on a conventional loan, the max back end debt to income ratio allowed is 50%. Does not matter how well qualified you are, does not matter how much money you have in the bank or what your credit scores are. 50% is as high as you're going to go. So that means this back end ratio cannot exceed 50%. So let's go in here and change a couple of numbers around so you guys can see that. So we're going to go back over here. We're going to change this from VA to a conventional loan. And that way we can get correct numbers in here to make sure that everything is right. So conventional fixed, this is going to be a purchase. And then we're going to do a primary residence again. And that way all these numbers will readjust and we're going to get some accurate information here. Now, one thing that's important to understand, there are several things that go into debt to income ratios and mortgage payments, and I'm going to show you that right now. So a VA loan has what's called a VA funding fee. And so that gets rolled into your VA loan. And I did not go over that with you guys a second ago when I did the VA loan, but I'm going to do it on the conventional loan. So we can't do 100% financing on a conventional loan. So let's just assume we're going to put 5% down. Okay. So there's our down payment, which is $15,000. Now we have a loan amount of $285,000. I'm going to keep the rate the exact same. We're going to keep the insurance the same, the property taxes the same, because I want you to be able to compare these programs. So 5% down, our payment's $1,932.91, but we're missing something because this is a conventional loan. When you are borrowing more than 80% of the purchase price of the home on a conventional loan, you have what's called mortgage insurance. Some people call it PMI. For this video, we're going to talk about it being mortgage insurance. So mortgage insurance is an insurance policy that's actually taken out on you as the individual person. It protects the lender in case you default on your mortgage. Conventional will insure a portion of that loan and pay out on that insurance policy if you default. It doesn't do anything for you specifically. It just protects the lender. VA has a very similar one. It's just a VA funding fee, and that gets rolled into the mortgage. There's also one on FHA. FHA has upfront mortgage insurance premiums plus monthly mortgage insurance premiums. So it gets a little more complicated. But on conventional, it's just built into the monthly. So let's just assume you have good credit, not an issue, because mortgage insurance on conventional loans is score-based. The higher your credit score, the lower the cost of mortgage insurance. So let's plug in mortgage insurance. And mortgage insurance is based on what are called factors. So it's percentages of the loan amounts, but there's factors that mortgage insurance uses. So we're just going to assume a factor of 0.65. We always put it on there for 10 years, and it always cancels at 78%. So your mortgage insurance is $154.38 a month. Now your new mortgage total payment is $2,087.29, which made your debt to income ratio, your front end, 33.397, your back end is 39.797. So it changes those numbers around. If you buy a home with a homeowners association, you've got HOA dues that are due every month or every quarter or every year. We have to include those dues in your total debt to income ratio calculation as well. So let's just assume that you've got a community pool and your HOA is $25 a month. So we're going to add that into your mortgage payment. So now your total mortgage payment is $2,112.29. And you can see up here that your debt to income ratio has changed accordingly. We're still below the 50% debt to income ratio, which is great. That means assuming excellent credit and that everything else in your file looks good. You have a great option here to qualify for this mortgage at a $300,000 purchase with 5% down on a conventional loan. So in your mortgage payment itself, it will include principal and interest, homeowners insurance, taxes, and mortgage insurance on a conventional loan. No mortgage payment ever includes the HOA. That's a separate bill that you will pay on your own if you're in a subdivision that has an HOA. So this is what debt to income ratios look like from a conventional standpoint. So we've talked a little bit about VA. We're now talking about conventional. Let's go talk about FHA for a second. So remember these debt to income ratios up top. So remember we're at a 95% loan to value, 33.7 front, and a 40.197 back end ratio with a max of a 50% debt to income ratio on conventional. Okay. FHA does not have that 50% max. So let's go over here. We're going to change this over to an FHA loan. The benefit for FHA lending, as an example, is it gives you more flexibility on your debt to income ratios. And the underwriting algorithm that is used on FHA is usually a little more flexible as well. So we use it a lot for first-time home buyers because it gives them more flexibility in what they can afford. So we're going to do a purchase, primary residence. So all these things are exactly the same. Remember, we've used the exact same thing. Primary residence, it's a purchase. We've done VA, conventional, and now we're doing FHA. So let's go back over here real quick. So FHA is a 3.5% down loan. So $300,000 purchase, 10.5 down. The rate we're leaving identical. The homeowners insurance and the property taxes we're leaving the same as well. We're not going to mess with those. The mortgage insurance changes. Now here, I'm pulling up the screen because I want you to see it. You get a 1.75% upfront mortgage insurance premium that gets rolled into your mortgage. So remember, your loan amount was $289.5. Now you have upfront mortgage insurance premium, which means you're paying an upfront fee for FHA mortgage insurance, which is $5,066.25 on this specific example. That gets added to your loan amount, and now your new loan amount with it rolled in is $294,566. The monthly mortgage insurance is a factor of 0.85, and it never cancels. Right now, the way FHA is set up, mortgage insurance is for the life of the loan. There is discussion that they may change this back where mortgage insurance may terminate, but right now it's still for the life of the loan on FHA. So look what this does to your payments. Your payment went up to $2,226.05. Now, the payment increased that much because of a couple different things. Number one, you're putting less money down. That definitely impacts your total payment. Plus the upfront mortgage insurance with the monthly mortgage insurance increased your payment as well. Now, a couple things to think about when you're looking at different loan programs. Conventional loans require a minimum credit score of 620 to qualify. They are very heavy score-based interest rates. So what that means is if you have, let's just say less than perfect credit, let's just assume a 620 credit score on conventional, which is the minimum, the mortgage insurance can be very, very expensive on conventional because remember I told you it was score-based. So the higher your credit score, the lower the mortgage insurance is. And the reverse is also true. The lower your credit score, the higher the mortgage insurance is on conventional loans. On FHA, that's not the case. Mortgage insurance is a fixed number. It doesn't matter what your credit scores are. The mortgage insurance is the same across the board. So if you have those lower credit score ranges, or if you want to put less money down than what conventional is requiring, FHA is a great choice. Or if you want to go to a higher debt to income ratio than conventional allows, again, FHA is a great choice. So your debt to income ratio up here, your front end is now a 35.617 and your back end is a 42.017%. So you can see that every program has a very different debt to income ratio, a very different calculation. So when you're looking at qualifying for the best program for you and your family, it's a loan officer's job to figure out what's going to qualify you for the most amount of money with the lowest amount down at the best interest rate and the best payment. And you can see that there's a very wide difference between all three programs. Now, for a VA loan, you do have to be a veteran. Conventional and FHA, it's pretty straightforward. There are different restrictions on those loan programs, and so you would need to visit with your loan officer to get the individual restrictions in your county, because there are differences county to county on FHA as an example. But they're all fantastic programs. So just to recap, remember our debt to income ratio has a front end and a back end debt to income ratio. It depends on the program that you're using as to what these numbers are going to be. But the front end is the mortgage the mortgage payment by itself. The back end ratio includes anything that you pay on a monthly basis. All right. Well, I hope that explains debt to income ratios and how programs can vary between each other. Please feel free to comment below, ask any questions. I'm always happy to run numbers for you guys and kind of explain what you may or may not qualify as well. There's some easy techniques to do that. And I hope we get to talk real soon. Check out my phone number. It should be scrolling across the page now. I put it on the video a little bit earlier as well for you guys. And, give me a call. Would love to visit with you and see what we can do to help you get your mortgage taken care of and find the best program for you and your family. All right. Thanks again. Have a great day. Bye-bye.